the levels that actually hold. Most traders lose money on support and resistance and never realize the problem was them. Not the market, not the news, not their broker the way they were drawing the levels. I know that because for the first couple of years, that was me. I'd litter my chart with lines, take a trade off one of them, get stopped out, and quietly blame everything except the one thing I could control. So here's the promise. By the end of this video, you'll be able to open any bear chart, no indicators, and know within seconds which levels are worth trading and which ones are traps that'll eat your account. I'm going to give you 5 checks I run on every single level before I risk a penny, and later I'll walk you through a live example where those 5 checks lined up perfectly. Stick with me, because that example is the whole point. What support and resistance actually are. Let's strip this back to basics, because if the foundation is wrong, nothing built on top of it holds. Support is the floor. It's the area where price has shown it's more likely to bounce and push higher, so it's where you want to be hunting buys. Resistance is the ceiling, the area where price has struggled to go higher and tends to reverse, so it's where you want to be hunting sells. That one idea already gives you a rulebook. Price near support? You're only looking for buys. Price near resistance? You're only looking for sells. You're not allowed to short into the floor or buy into the ceiling just because a candle looked exciting. Half of getting profitable is simply refusing the trades that point the wrong way, and this rule alone filters out a huge chunk of the rubbish. Now, why do these levels even exist? Think of it as supply and demand, and remember who moves the market. You and I can jump in and out in a blink our size is nothing. But a fund that wants to buy 2 billion pounds of something can't just slam that order in. It would spike the price against itself and get a terrible fill. So instead, they sit a resting order at a chosen level and let price come to them, buying in pieces every time it dips back to that area. That's the mechanism behind a bounce. Their order is too big to fill in one touch, so price keeps getting rejected from that area while they quietly get filled, and every rejection is a footprint they leave on your chart. When price returns to a spot it's clearly bounced from before, you can reason that big money is probably still working an order there and lean on that edge. It's not magic, and it's not certainty. It's just reading where the heavyweights left their fingerprints. There's a second reason levels form, and it costs nothing to spot. Psychology. Round numbers. Look to the right of your chart, and the big even figures pull price like magnets, because they're where everyone's brain naturally places orders. On GBP USD, 1.25 matters more than 1.2483. On gold, 2,400 matters more than 2,387. And 2,500 matters even more than that. The rounder the number, the more orders cluster there, and the more reaction you tend to get. And yes, every level eventually breaks. That's not a flaw. It's how markets breathe. Either the institutional orders finally get filled, and there's nothing left to defend the level, or supply and demand simply reach a balance, and the crowd that was fading it gives up. Your job isn't to find levels that never break. It's to find the ones most likely to hold this time, and to know quickly when they've failed so you're out before it hurts. Strong levels versus weak levels. So how do you tell a level worth trading from one that'll betray you? Start with the most basic filter. Has price touched it at least twice? One clean swing into an area tells you almost nothing. You don't yet know how price behaves there. But when an area has been respected 2 or 3 times, the next touch is one you can actually lean on with some confidence. The second thing I look at is the quality of the reversal. When price hits the level, does it snap away fast and hard, or does it ooze off it half-heartedly? A sharp, decisive rejection tells you there was real force waiting there. A slow, mushy turn tells you the level is weak and might not survive the next test. Speed of the reaction is information respected. And here's something a lot of people miss. A level doesn't have to be a flat horizontal line. It can be diagonal. 2 clean touches along a rising line give you a trending support. 2 along a falling line give you trending resistance. Same concept, same institutional logic, it's just tilted. When the third touch taps that diagonal and reverses, it's every bit as tradable as a horizontal one. Don't limit yourself to flat lines and miss half the map. Now flip it. What makes a level weak? Drawing it off a single swing, high, in the middle of a strong trend. If gold is powering upward, and you mark the latest high as resistance, expecting a big reversal, you're fighting momentum with a line that has never proven itself. That's a weak level. And a moment price slices clean through it, do yourself a favor. Delete it. Don't keep a dead level on your chart hoping it comes back to life. It clutters your view and tempts you into bad trades. Stop drawing lines, draw zones. This next shift changed my trading more than anything else. So lean in. Stop thinking in lines. Think in zones. Price almost never reverses at the exact same tick. Twice it reverses somewhere in an area. So instead of a razor-thin line at 2400.0, mark a band, maybe 2398 to 2404, and let price react anywhere inside it. It can tap the top, the middle, or briefly poke the bottom, and still be a valid reaction. How do I actually draw a zone? I take the most extreme wick of the swings as one edge, and the cluster where the bodies of the candles turned as the other edge. That captures the extreme and the meat where most of the reversal happened. Keep it tight. A zone that's too wide is just an excuse to justify any trade. The goal is a realistic band, not a hopeful blanket thrown across half the screen. The 2 setups every good level hands you way. Once you can find a level that matters, it gives you 2 clean setups. The first is the break and retest. A resistance that finally breaks often flips into support. Price pushes up through the ceiling, pulls back down to it, taps it from above, and continues higher. It's that classic staircase you see in a clean trend, and plenty of traders build an entire strategy on just this one pattern. It works long and short. A broken support flips to resistance the same way. The second setup is the one that traps beginners every single day. The failed breakout, or fake out. Price pokes above a range high. Breakout buyers pile in expecting a rocket, and instead, price snaps straight back inside the range and sells off, running every one of those late buyer stops on the way down. It feels like a breakout, it's dressed like a breakout, and it's actually the opposite. Learn to see it, and you stop being the liquidity. You start using it. So how do you tell a real break from a fake one before it's obvious? Look at what price did at that same level last time. If it fakes out there once, it's very capable of doing it again. Check the bigger picture. If the market is stuck in a sideways range, a sudden clean breakout into a brand new trend is the less likely outcome. Chop favors the fake out. Momentum and context decide it, not the single breakout candle that gets everyone excited. And here's the mechanical reason fakeouts happen so reliably. Once you see it, you can't unsee it. Just above an obvious range high sits a pile of stop-loss orders from everyone short inside the range, plus the buy-stop orders of breakout traders. That cluster of orders is fuel. A push through the high triggers all of it at once, which is exactly the burst of liquidity a big seller needs to get filled. Price spikes just far enough to grab it, then rolls over. You're not being unlucky, you're standing where the liquidity is. My 5-point checklist for confirming any level. Right. This is the core of the whole video. The 5 checks I run on every level before I risk anything. Check 1. Higher time frame. Always pull your levels from a bigger picture than the one you enter on. I might enter on a 1-minute chart, but I mark my zones on the 15-minute or the hour, because that's where the meaningful reversals live. Zoom in too far, and a gentle pullback looks like a screaming trend. Zoom out, and the real structure appears. Check 2. Trade the extremes, not the middle. The strongest levels sit at the outer edges of a range, where price is so stretched that fresh buyers step in at the lows and fresh sellers step in at the highs. The middle of a range is a minefield. That's where you get chopped, faked, and stopped. If you catch yourself drawing 5 levels across one range, you're overcomplicating it. Mark the extremes. Ignore the noise between them. Check 3. Multiple touches, we covered it, but it earns its place on the checklist. At least 2 prior touches before I trust a level, ideally with clean reactions each time. A level with a history is a level with an edge. A level with no history is a coin flip I'm choosing to call a strategy. 2 touches, minimum. No exceptions to lie to myself about. Quick pause. If this is landing and the checklist is starting to click, a like genuinely helps this stuff reach more traders who are stuck exactly where I was. Right, back to it. Check 4. The strength of the move away from the level. When price left this zone last time, did it explode away or drift? A powerful, fast departure tells you serious orders were sitting there. Big moves off a level are a vote of confidence. Limp moves are a warning. Check 5. And the biggest game changer of the lot. Treat every level as a zone, exactly like we drew earlier. This is the check that stops you rage quitting a perfectly good level just because price overshot your line by a few pips. When all 5 line up higher time frame, extreme of the range, multiple touches, strong moves away, and a clean zone, that's when I'm genuinely interested. Fewer than that, and I usually just wait. You might be wondering why there's not a single indicator in any of this. Here's the honest answer. Indicators are just maths done on the same price you're already looking at. They lag it because they're derived from it. Support and resistance is the price itself, and the orders behind it, with nothing in the way. When you strip the chart bare and read levels directly, you're reacting to what the market is doing rather than to a smoothed-out echo of it 3 candles late. Fewer tools, clearer decisions, faster reactions. A real, current example. Gold at the $4,000 magnet. Let's ground all of this in what gold is actually doing as I record this. Xauusd has had a wild year. It printed an all-time high up near 5,600 back in January, then corrected hard, dropping roughly a quarter of its value, and is now consolidating in a broad range. The floor traders keep pointing to sits around 3,960, and the ceiling caps out up near 4,300, with a huge round number at 4,000 acting as the pivot everyone's watching. That's not my opinion, that's the structure the market has drawn for us. Look at how neatly the round number does its job. 4,000 isn't special because of any indicator. It's special because it's where thousands of traders' brains put orders, alarms, and stops. Price keeps gravitating to it, hesitating around it, and reacting from it. That's exactly the psychological level idea from earlier, playing out live in the biggest market of the moment. So let me build a textbook setup around this level using the 5 checks, with numbers kept clean for teaching, putting it together a worked gold setup. Here's the open loop I promised at the start, paid off. Picture gold ranging just under the 4,000 ceiling, a round number it's already faked out of once before. On the 15-minute chart, the market is clearly sideways. No strong trend, just chop between support down near 3,960 and that 4,000 ceiling. Check 1. Higher time frame. Done. I'm reading structure from the 15-minute, not scalping blind on the 1-minute. Now the checks stack up fast. The 4,000 area is the extreme high of the range check 2. It's been tapped 3 times with sharp rejections check 3, plus check 4 for the strong drops each time it's been hit. And I'm treating it as a zone, roughly 3,997 to 4,004. Not a single hairline check. 5. That's 5 out of 5. On top of that, the round number already faked out once, so a second fake out is very much live. Everything points one way. Fade the ceiling. So the plan writes itself. I wait for price to push into the 3,997 4,004 zone, ideally poking just above 4,000 to trap the breakout buyers. Then I want a clear rejection, a sharp candle closing back inside the range. Entry on that rejection. Stop tucked just above the zone at around 4,008, so the fake out has to genuinely fail before I'm taken out, and a target back down towards the range floor near 3,960. Clean, defined risk, built entirely from the 5 checks, no indicator, no guessing, and roughly 2-to-1 in my favor. And notice what I did not do. I didn't dive onto the 1-minute chart and get seduced by every little candle. I didn't add 3 indicators to feel clever. I let the higher time frame picture make the decision, and I used a small time frame only to time the entry once the big picture already said yes. That discipline, big picture first, entry second, is the difference between trading a plan and reacting to noise. 5 mistakes that quietly kill accounts. Before we recap, let me save you the pain I paid for the mistakes that don't blow you up in one trade. They bleed you slowly. Mistake 1. Trading every level. Not every level deserves a trade. If it doesn't pass the 5 checks, the correct action is to do nothing and wait. Patience isn't the boring part of trading. It is the trading. The best traders I know pass on far more levels than they take. Mistake 2. Moving your stop when price gets close. You set the stop above the zone for a reason. It marks where your idea is wrong. The moment price threatens it, and you slide it further away to give it room, you've stopped trading a plan and started trading hope. Set the stop, then leave it. If it gets hit, the level failed, and you were right to be out. That's a good loss, not a bad one. Mistake 3. Fighting the trend at a weak level. We said it earlier, but it bears repeating because it's the account killer. In a strong trend, a fresh high or low is usually a pause, not a reversal. Trying to short every new high in a raging uptrend because it must be resistance is how good traders donate to the market. Trade reversals at proven extremes. Trade continuations in the direction of the trend. Don't mix the two up. Mistake 4. Ignoring confluence. A level is stronger when more than one reason points to it. A round number that also lines up with a range extreme and a rising trend line is far more compelling than any one of those alone. The more of your checks stack in the same spot, the higher the quality of the setup. When you see 3 or 4 reasons converge on one zone, pay attention, that's where the cleanest trades live. Mistake 5. No plan for the break. Every level fails eventually, remember? So before you enter, know what invalidates the trade and what you'll do if the level breaks instead of holds. Sometimes a clean break and retest of your failed level becomes the next trade in the opposite direction. The market hands you a second setup if you're not busy being angry at the first one. Plan the hold and the break. Then, whatever happens, you already know your move. Second example, a GBP USD break and retest. Let's do one more, a continuation trade this time so you see both sides. Say GBP USD has been grinding up in a clean uptrend and stalls under a resistance shelf at 1.275. Higher time frame first on the hour. The trend is clearly up, higher highs and higher lows. So I'm biased to buy pullbacks, not fade strength. This is the opposite context to the gold trade, and the context is what changes my whole approach. Price breaks up through 1.275 with a strong, fast candle. Check 4, a powerful move. Instead of chasing the break, I wait. In an uptrend, a broken resistance often flips to support, so I want the retest. Price pulls back down to the 1.2748, 1.2755 zone, taps it from above, and holds that old ceiling, is now acting as a floor. That's my break and retest in the direction of the dominant trend, which is exactly the setup I want to be taking. The plan: enter long on the hold of the retest, stop just below the zone at around 1.2735 where the idea would be wrong, and target the next higher time frame resistance above, aiming for at least twice my risk. Same 5 checks, same discipline. The only difference is that here, the trend told me to buy the retest instead of fade the extreme. Read the context, let it choose the setup, then execute the plan without arguing with the chart. Your drill for this week. Knowledge you don't practice evaporates. So here's a drill you can start tonight. Open one pair, pick just one, gold or a major like GBP USD, on the 15-minute or hourly chart. Scroll back in history and, using only the 5 checks, mark the 2 or 3 strongest zones you can find. No indicators. Then scroll forward, candle by candle, and watch how price actually reacted at each one. You're training your eye to spot quality levels before they play out. Do that for 10 charts and something clicks. You stop seeing a wall of random candles and start seeing the same handful of situations repeat. The range extreme that holds, the fake out above the round number, the break and retest in a trend. That pattern recognition is the whole skill, and it's built through reps, not through buying another indicator. Keep a simple journal of what you marked and what happened to your own chart history is the best teacher you'll ever have. What to actually remember. Let's lock it in. Support is the floor, resistance is the ceiling, and they exist because big money leaves orders and because crowds cluster at round numbers. Strong levels have at least 2 touches, sharp reversals, and can be diagonal as well as flat. Draw zones, never thin lines. Every level offers 2 setups, the break and retest continuation and the failed breakout trap. And before you risk a penny, run the 5 checks. Higher time frame, the extremes, multiple touches, strong moves away, and treat it as a zone. Do that consistently, and your chart stops feeling like chaos and starts feeling like a plan. You'll take fewer trades, but they'll be the right ones. And in this game, fewer and better beats more and worse every time. If this gave you a clearer way to read levels, subscribe and turn on the bell, because the next breakdown builds directly on this one. Exactly how I time entries inside these zones on the lower time frame. Drop a comment telling me which of the 5 checks you've been skipping. I read them.